Microsoft has committed $17.5 billion to infrastructure in India. Google is deploying another $15 billion. The capital flowing into the Indian digital backbone is staggering. But step away from the corporate press releases, and the reality of this sector looks very different. It looks like a massive diesel generator humming at 3 a.m. in Manasar, burning fuel to cool row after row of heat-exhausting servers. Driven by billions of monthly UPI transactions and the vast public digital stack, India's data center capacity is expanding fourfold. The demand is completely real. Retail markets look at that demand and view domestic data center stocks through a purely technological lens. They apply software multiples to the sector, expecting infinite, frictionless scalability and interchangeable growth. A data center is a hard asset, finite resource utility business. The moat relies on concrete, raw megawatts, and strict physical proximity to network fiber. Applying high-growth tech valuation multiples to a business constrained by heavy physical inputs is a structural analytical error. Investors chasing the AI narrative without understanding the underlying physics are walking directly into a trap. Before a single rupee of revenue can flow, an operator has to acquire land, but they need a highly specific parcel, low seismic risk, adjacent to heavy transmission lines, and accessible to existing fiber networks. Once the land is secured, they hit the primary bottleneck, the state electricity distribution companies. Securing high-tension grid connections is heavily constrained by strict capacity limits and local political priorities. A sanctioned load of 30 megawatts does not get approved in 90 days. In many states, the paperwork for grid access takes 18 months, and frequently longer. Local grid capacity at any given electrical substation is finite. When the power is allocated, it is gone. A 50-megawatt sanctioned load in a congested corridor is an act of competitive foreclosure. It forces any new entrant to wait at the back of a multi-year queue with a DISCOM that has other priorities. First movers in the power queue secure localized grid monopolies. They operate toll booths on the digital highway. The shift to AI compute has broken legacy economics entirely. A traditional co-location server rack draws about 3 to 5 kilowatts of power. A modern AI inference cluster pulls anywhere from 30 up to 100 kilowatts per rack. Pushing that much energy generates massive thermal exhaust. Traditional air cooling, the industry standard for 2 decades, is hitting hard physical limits against these extreme densities. AI-grade facilities require direct-to-chip liquid cooling as a structural baseline. These industrial chilled water systems manage the thermal density that air cooling cannot physically dissipate. This brings us to power usage effectiveness, or PUE. It is a strict ratio, the total amount of power a facility consumes divided by the actual power used by the IT equipment. This chart compares average performance. The average Indian data center runs at a PUE of 1.6. Best-in-class hyperscale facilities operate around 1.1. That gap represents electricity entirely wasted on overhead losses like cooling and lighting. That half-point difference translates directly into a compounding margin differential. It bleeds the facility's profit and loss statement every single month. For institutional investors evaluating these companies, PUE is the most honest, unfiltered signal of operational quality and bottom-line survival. Data centers do not simply seek out the cheapest available real estate. A facility in a Tier 2 city fails because it lacks immediate physical proximity to major internet exchange points. Routing an application out to a cheaper inland city adds 10 to 20 milliseconds of round-trip time. For high-frequency financial trading and real-time AI inference, that delay is architecturally unacceptable. High-cost markets like Mumbai and Chennai dominate capacity for one strict reason: they sit at the physical intersection of global undersea cables. Once a hyperscaler deploys thousands of servers into one of these prime locations, they run miles of cables and configure custom power distributions. The operational cost of migrating involves severe downtime windows and complex recertification. The customer who lands in a facility in year 1 is statistically there in year 5. Customer stickiness is enforced by the physical gravity of the infrastructure, creating winner-take-most micromarkets. This matrix categorizes the 4 major listed Indian data center entities. Treating these distinct operating models as interchangeable businesses is a severe valuation error. E2E Networks is not a traditional co-location facility. It is a GPU compute rental business. Over 70% of its revenue comes directly from cloud AI processing. The market punished the stock heavily by looking at its net income through a simple price-to-earnings ratio. They missed that the heavy, front-loaded depreciation on newly commissioned GPU clusters was temporarily masking a 56% EBITDA margin. The correct metric here is EV to EBITDA. The true test of the business is tracking whether their revenue, growing at 68% year-on-year, maintains enough velocity to justify the hardware depreciation curve over the asset life. Netweb Technologies operates as an asset-light supplier of high-performance computing systems. They ride the capital expenditure wave, selling hardware without taking on the multi-hundred crore infrastructure lock-in risks of a developer. Anant Raj is an asset turnover real estate play. Because they hold massive land banks and early revenue is dwarfed by high deployed capital, their current return ratios look artificially weak. The stress test for their thesis is their debt-to-EBITDA trajectory in FY27 and FY28. You have to track if they can manage the debt load as construction capex peaks against their massive 300-megawatt pipeline. Finally, the market prices Techno Electric as a standard EPC contractor. In reality, they are an energy infrastructure firm actively solving the critical local grid power bottleneck for AI workloads. Using a uniform PE multiple across a hardware supplier, a real estate developer, and a power contractor ignores their distinct physical risks. This uniformity is exactly what creates the valuation trap. The bullish projections for the sector assume all planned facilities will effortlessly draw the power they need. We have to ask if the physical grid can actually evacuate that load. This diagram illustrates the evacuation bottleneck. India has an ample 520 gigawatts of installed national capacity, but data centers concentrate in tight clusters, creating massive 24/7 continuous loads that break local infrastructure. Upgrading a substation and approving new transmission lines in a congested urban corridor takes 18 to 36 months. A fully built campus generates zero revenue if the local feeder cannot safely deliver the contracted load. Operators try an open access workaround, bypassing the state grid to buy directly from renewable generators. But these agreements carry long approval lead times, and the intermittent nature of solar and wind still demands massive thermal backup. Then there is the secondary constraint completely missing from financial models. High-density liquid cooling requires intense, continuous water procurement. Sites in Pune and Chennai have well-documented histories of municipal water stress. Localized grid bottlenecks and municipal water rights represent the true ceiling on AI expansion, proving more restrictive than the global supply of silicon chips. Domestic co-location providers currently act as mall developers, providing rapid infrastructure for hyperscaler anchor tenants. The structural risk is that those anchors eventually build their own mega campuses and vacate the space. Because of this, the single most important due diligence variable for any data center stock isn't the megawatt pipeline on an investor deck. It is the operator's localized power procurement history and their ability to execute on the physical grid. The enduring assets in this sector require a specific trinity: controlling land with sanctioned DISCOM power, engineering cooling infrastructure capable of handling 50-kilowatt racks, and securing physical adjacency to undersea cables. The logic matches the toll road boom of the 1990s. We are watching the aggressive capture of finite physical infrastructure facing guaranteed growing traffic. The companies successfully locking down these uncopyable bottlenecks are accumulating the hard assets that will dictate the flow of India's digital economy for a decade.